In this final video on working capital management, we're going to switch gears and talk now about the other side of working capital management, which is dealing with and managing the current liabilities of the company. Essentially, current liabilities, there's three structures, three parts to them, if you will. There's short-term debt management, accrued liabilities management, and accounts payable management. Now, accrued liabilities are an accounting structure. They're a function of the way accrual accounting works. So they are really not necessarily what one might consider a liability. They are an accounting function. But short-term debt management and accounts payable management are indeed things that the company has to deal with because they are truly what a person thinks of when they think of borrowing. So short-term debt management consists of some business obligations that have to be paid within a certain time frame, within the current time frame. So we have current payments on long-term debt, maybe some bank line credits, maybe some notes payable that are due. Accounts payable follow in this short-term debt area. And we also could have just short-term loans that are for less than a year. So one of the things that we can think of or talk about are things that are referred to as a line of credit. These are similar to a credit card. So you can obtain a certain amount of money that you can borrow, a credit limit. Now, you're not obligated to make payments on this until you actually borrow the money. So this line of credit, you typically get that from a bank. And of course, this is used to help us with our cash needs when maybe the cash outflow exceeds our current cash inflow. So it helps to manage the day-to-day influx and outflux of cash within the particular company. As I mentioned, accrued liabilities really come from the accounting process. Things like payroll taxes, property taxes, etc. Some of these things are pay as you go, but the bill is not owed till later. Some of these things are you owe them now and you're going to make payments over the near future. So these are really more an accounting function than any other part. The thing that we want to spend most of our time talking about are accounts payable. This really is every business that especially businesses that handle inventory, every business has an accounts payable. Essentially, just as people borrow money from us in an accounts receivable form, it's an interest-free debt that we owe when we have purchased our inventory. And there are three forms of this, if you will: a trade discount, cash discounts, and quantity discounts. Now, trade discounts are amounts that are deducted from the list price when a person performs some form of service. So again, these might be something that's called here 30, 20, 10, right? That there's a series of these, so that means there are a series of obligations that need to be met in order to make that payment. So for instance, 30% might be if you sell at the invoice at the retail suggested price, then you can buy from us at 30% off. So if it's $100, you can buy it essentially for $70. When you sell it for $100, the $30 is the profit you make. But there could be other contractual arrangements like installation costs, etc. So there could be a variety of contractual obligations that you can meet. So as we go down the list here, when we talk about this 30, 20, 10, right, it's 30% of the price is the first line item. That would be of $300. 30% of that is $90, so you would pay $210 would be what you would pay if you only met that one obligation. But you get 20% off of that. So 20% of 210 is $42. So then your selling price, if you met both obligations, would be your purchase price, would be $168. So your profit, 168 less from that, we end up with 130 some odd dollars, $132. Now, some of that is going to be met up by some of the contracts. So there is an expense to doing the obligation. So this isn't pure profit, but it just sets a discount price so that you can do business with this particular company. So we can look at this a couple of different ways, right? There's something what's referred to as the net cost rate factor. This is the lowest the amount of the price that you would pay if you took all of these trade discounts. So it's 1 minus this cost factor is what they would refer to as what they refer to as something called the single equivalent discount. But again, we don't need to necessarily take all of these discounts. If you only did 2 of the discounts, your net cost rate factor would be 0.7 times 0.8. So that would be 0.56. That would be the amount that you ultimately would pay excuse me, to buy this particular piece of inventory. Now, cash discounts are different because cash discounts are offered to try to entice customers to pay more promptly. And these are a lot more prevalent in current business environment. I want to sell at a cash discount, right? So the seller views this as a sales discount, but the customer views it as a purchase discount. So really, if you think about this as a person who's buying the asset, buying the inventory, you want to set the price at which you pay for inventory. So for my perspective, this allows you to buy inventory cheaper. If you buy inventory cheaper, that means you can make a higher profit when you sell at your selling price. So a cash discount, in this case, 210 net 30, means you can deduct 2% of the invoice if you pay within 10 days. If you don't pay within 10 days, then that means you have to pay the entire 100% of the loan. So essentially, you get 2% less to buy your inventory, which that 2% of price ultimately falls to the bottom line, the profit per sale. So if you pay after 30 days, maybe we have to add a monthly charge, or maybe there's something else that's added to it. But essentially, 210 net 30 says you're either going to pay at the end of 10 days or you're going to pay at the end of 30 days. And there is a price difference, obviously, if you do that. So if it's a $10,000 invoice, right, if you pay this off within the first 10 days, not within the first day, if you would only pay on the 10th day or the 30th day, there's no other time you would pay, then the price that you would pay is $9,800, or essentially you save $200 on the selling price of this asset. When you buy the inventory, you would earn $200 more from the sale. Or you can just decide to pay on the 30th day. So how do we figure out what the cost differential is? Now, this is not really what you would refer to as a cost. This is an opportunity cost. You have the opportunity to buy your inventory cheaper, and you decide not to do that. So you're going to pay the actual price of the inventory. So we want to figure out what this opportunity cost is. And we want to compute that in the form of an interest rate, because essentially you are financing. You could buy it 2% less, or you can finance it for another 20 days, which means at the end of 20 days, the price differential is really an interest kind of a cost. So how we could calculate that, $200 is the cost you pay for $20. So that interest rate, $200 divided by 9,800, That's a 2.04%. That's the actual cost, the interest on the actual purchase. However, we want to annualize this. So if you put this in annual terms, we need to multiply this by 365 days divided by the number of times per year that you're going to do this. That's what this refers. Every time you do this, we're going to assume you're not going to pay the discount. So that means roughly 18 times a year, you are going to buy something, forego the discount, and pay at the end of 30 days. So the actual effective cost is 37.23%. So again, this isn't an actual expense, right? It's not an interest expense per se, but this is the cost of taking the discount. And 37.23% annualized is a huge cost, is a huge financing cost. So what should a person do? If you can't pay in the first 10 days, it might be beneficial to borrow money to pay off this in the first 10 days. That way you would save on this 37%. So if you could borrow at 10% for another 10 days, again, you would be reducing the overall cost of the inventory through this financing method. The last way we can deal with accounts payable management and dealing with how much we pay for our inventory, when we pay for it, they refer to things called quantity discounts. And I'm sure we're all familiar with this. We have an inventory number, right? And if you buy between 101 and 99, it costs $15. 100 to 499 is $14.50, etc. So we have a graduated price that we ultimately pay for our units. Now we can also incorporate into these graduated prices, what if they also offer us a cash discount? So you can take a quantity discount and you can take a cash discount. And the objective for this is to find a way that we can purchase our inventory at the lowest possible cost. Inventory management is to find out how much stuff we need to buy so that we can minimize the cost of having inventory. So this is the paying of inventory. Inventory management is the cost of having inventory. And accounts receivable, that is the actual analysis of how long it takes for us to get the money so that we can continue this cycle of purchasing inventory and selling inventory. So that's the end of our videos on current liability and current asset management, which we define at NET as being working capital management.